Imagine you have $500,000. You can use it to buy a house. Or you can rent that same house for $2,500 a month and invest the money you didn't put into the house. At first, buying feels like the obvious winner. Because every month, the renter is throwing money away, while the homeowner is building equity. But here's the uncomfortable part. That sentence can be completely wrong, because when you buy a home, you're not just paying for a house. You're paying interest, property taxes, insurance, maintenance, closing costs, and most importantly, you're giving up the opportunity to invest the money somewhere else. So the real question isn't, is buying better than renting? The real question is, which choice leaves you with more wealth after 10, 20, or 30 years? And once you do the actual math, the answer gets a lot less obvious. Let's say you're looking at a $500,000 house. You have $100,000 available for a down payment, so you take a $400,000 mortgage. At a hypothetical 6.5% interest rate over 30 years, your principal and interest payment is roughly $2,528 per month. That sounds manageable. But that's only the first line of the bill. Add property taxes, homeowners insurance, maintenance, and potentially HOA fees. And suddenly, that $2,528 mortgage payment might become something closer to $3,500 or even $4,000 a month in total housing costs. And here's where the psychology gets interesting. When people look at a mortgage payment, they see one number, but economically, that payment is doing several completely different things. Part of it is paying down your loan. Part of it is interest going to the bank. Part of it is taxes going to the government. Part of it is insurance. And part of it is simply the cost of keeping the property alive. Only one part is actually increasing your ownership stake. That's principal. The rest is an expense. Now let's look at the renter. Suppose that same house rents for $2,500 a month. The renter pays $1,000 less than the homeowner's hypothetical $3,500 monthly housing cost. That's $12,000 a year. Over 10 years, that's $120,000 in cash flow difference. But there's another number sitting quietly in the background. The $100,000 down payment. The homeowner put that money into the house. The renter didn't. And that creates what economists call an opportunity cost. In simple English, money sitting inside your house can't be invested somewhere else at the same time. Suppose the renter invests that $100,000 instead. And suppose they invest the monthly $1,000 difference as well. At a hypothetical 7% annual return, compounded over 10 years, that investment could grow to roughly $320,000. Not guaranteed. Not risk-free. But mathematically, this is the comparison that gets ignored. Because people often compare rent versus mortgage. But that's not the real comparison. The real comparison is rent plus investments versus home ownership plus home equity. Now comes the part that makes buying look much better. The house itself can appreciate. Suppose the $500,000 house grows at 3% per year. After 10 years, it would be worth around $672,000. That's a $172,000 increase in value. And because you used borrowed money to buy it, the homeowner gets something interesting, leverage. You controlled a $500,000 asset with $100,000 of your own money. If the house rises 3%, that's a $15,000 increase in value during the first year. That's a 15% increase relative to the original $100,000 down payment. Sounds incredible. And it can be. But leverage works in both directions. If the house falls 10%, the property loses $50,000. That's half of the original $100,000 down payment. Suddenly, the magic of leverage looks very different. And there's another problem. The homeowner doesn't actually get to keep that entire $172,000 appreciation. Because selling a house costs money. Real estate commissions, closing costs, repairs, and potentially taxes depending on the situation. So the headline number, "My house went up $172,000, isn't the same as, "I made $172,000. This is why real estate math is so deceptive. The asset has a visible price, but the true cost is hidden across decades. Now let's talk about the mortgage itself. At the beginning of a 30-year mortgage, a surprisingly large portion of your payment can go toward interest. Why? Because interest is calculated on the outstanding loan balance. And at the beginning, that balance is huge. So you might make a payment of more than $2,500, while only a few $100s goes toward principal. The rest, interest. This creates one of the biggest misconceptions about buying a home. People say, I'm paying $2,500 a month, but at least I'm building equity, yes. But not $2,500 of equity. Only the principal portion is equity. The rest is the price you're paying to borrow $400,000, and over 30 years, that interest can add up to hundreds of thousands of dollars, which creates a strange situation. A house can appreciate, your equity can grow, and yet you can still spend an enormous amount of money simply owning the property. Now flip the perspective. Renting has a cost too. Obviously, rent doesn't build home equity, and rent can increase. The landlord can raise the rent. You don't control the property, and if the housing market rises dramatically, the renter doesn't automatically participate in that appreciation. That's the strongest argument for buying. You're locking yourself into an asset, and if the property becomes much more valuable over time, you benefit. But there's one major advantage renters have that doesn't get enough attention: flexibility. If you buy a house and move 2 years later, the transaction costs can be brutal. You bought, you paid closing costs, you made mortgage payments, you maintained the property, and then you sell. Suddenly, a home that looked like an investment starts looking more like an expensive machine for transferring money between your bank account and everyone else's. That's why the length of time you plan to stay matters enormously. Buying can become much more attractive when you're planning to stay for a long time, because the upfront costs get spread over more years. But if you're constantly moving, renting can make far more financial sense. And now we reach the part most online rent versus buy calculators don't fully capture. Your life isn't a spreadsheet. Maybe you buy the house, then you get a new job in another state. Maybe your family grows. Maybe the neighborhood changes. Maybe you need cash for a business. Maybe the roof suddenly needs $20,000 of repairs. Or maybe the house appreciates beautifully, but almost all your wealth is now concentrated in one giant asset sitting in one location. That's concentration risk. Your retirement account can hold hundreds or thousands of companies. Your house is one house, one neighborhood, one local economy, one property, and you can't sell 7% of your kitchen because the stock market suddenly looks attractive. That's the hidden trade-off. Buying a home isn't simply a financial decision. It's a decision to lock a significant amount of your wealth into a relatively illiquid asset. And yet, there's an argument on the other side that is just as powerful. A mortgage can act like a forced saving system. Every month, you have to make the payment. You can't easily spend the equity you've accumulated, and after decades, if the mortgage is finally paid off, you own the property outright. The renter has no house. The homeowner has one. That psychological difference matters. But here's the uncomfortable question. What if the renter actually invested the difference consistently for 30 years? What if they didn't spend it? What if the investments compounded? Then the renter could potentially end up with a large investment portfolio while still having the flexibility to move whenever they want. So the rent versus buy debate ultimately depends on something much bigger than rent or mortgage payments. It depends on what you do with the money you don't spend. That's the variable people forget. A disciplined renter who invests the difference can look very different from a renter who simply spends the difference. And a homeowner who buys within their means can look very different from someone who stretches their finances to buy the biggest house a bank will approve. The bank doesn't ask, will this house make you wealthy? The bank asks, can you make the payments? Those are two completely different questions, and maybe that's the biggest lesson in the entire rent versus buy debate. A house is not automatically an investment just because its price goes up. And renting isn't automatically wasting money just because you don't own the walls around you. Both choices have costs. Both choices have risks. Both choices can build wealth. And both choices can destroy it. The real calculation is much bigger. How much cash do you put in? How much interest do you pay? How fast does the property appreciate? How much does rent increase? What does maintenance cost? How long do you stay? What could your down payment earn elsewhere? And perhaps the most important question, what will you actually do with the money you save? Because at the end of 30 years, the person who made the better decision may not be the homeowner. And it may not be the renter. It may simply be the person who understood the math and didn't let the word home make the decision for them.